The dreaded depreciation. We defined depreciation a few chapters ago as the way the company spreads the cost of a long-lived asset over the time it's actually being used. This gradually reduces the value of the asset. The current value is known as the book value. Book value is calculated as cost minus accumulated depreciation. Recall that accumulated depreciation is a contra asset account that tags along with the asset. The book definition of depreciation is that it is the process of allocating a plant asset's cost to expense over its life. As assets wear out and lose value, depreciation allows a company to record on the balance sheet the true value of the asset at a point in time. The expense is recorded on the income statement, so the cost is matched to the revenue it created. Land is the only long-lived asset that is not depreciated. A company needs to know three things to calculate depreciation. First is the cost, which is why we've spent so much time on that. Second is estimated useful life. How long can they use this equipment? How long will the building stand, etc. Last is the residual value, or what do they expect it to be worth when they're done with it? Sometimes it will be zero, but sometimes it might be worth something. The last two amounts are estimates, and you'll see that they sometimes change over time. There are three main depreciation methods. The first is straight line, which we've talked about before and we'll get into in more depth here. The second is units of production, and the last is double declining balance. You're given data that you will use for the following explanations of each method. A truck that cost $41,000 is expected to be worth $1,000 at the end, and it will last 5 years and go 100,000 miles. The straight line method is the easiest. You do one calculation and you're done forever unless something in the estimates change. The depreciable cost, which is the cost minus the residual or salvage value, is divided by the useful life. In this example, the cost is $41,000, the residual value is $100,000, and the useful life is 5 years. So each year, the company can record $8,000 in depreciation expense. Cost minus residual divided by 5 gives you the $8,000. The journal entry is a debit to depreciation expense and a credit to accumulated depreciation. Every year, the same amount of depreciation is taken. So each year, the amount of accumulated depreciation increases and the book value of the asset decreases by the same amount. Units of production method looks at how much something can produce or how far it can go. Think cars or delivery vans. You have to do two calculations with this method. First, you have to figure out a per unit cost. Then you use that to calculate your depreciation expense. Oops. In this example, the per unit cost comes to 40 cents a mile. 41 minus 1,000 divided by 100,000 miles gives you 40 cents per mile. Depreciation expense will vary according to use. Greater use gives greater depreciation expense, as you can see here. Double declining balance is the most complicated, but it gives a greater amount of depreciation in early years, so many companies use it for tax purposes. You have to figure out the rate per year. This frequently confuses students. The asset will be fully depreciated within a specific number of years. 100% divided by that number gives you a percentage for each year. Because it's double declining balance, multiply that percentage by 2. In this example, 1 divided by 5 equals 20%. Times 2 equals 40%. Each year, the previous year's ending balance is multiplied by that percentage to get the depreciation expense. In this example, year one book value is $41,000. Multiply that by 40% and you get $16,400. Book value is cost minus accumulated depreciation, so in year two we get $24,600 times 40% equals $9,840. In the final year, we plug in the amount that will bring us to the estimated residual value. Double declining balance does not consider residual value until the end, when the final depreciation expense is a plug. Comparing the three methods shows that straight line is best for assets that generate revenue evenly. Units of production is best for things that wear out, and double declining balance is best for things that get a lot of use in early years. You will always end up with the same total expense. You're just taking a different path to get to that amount with the different methods. Most companies use straight line because it's the easiest. And this is showing you the different paths that you get to. You can see straight line is used by most of them.